best way if you want to actually rig a valuation too. So as we go through this, kind of keep in mind that they serve both purposes in some cases. Hopefully you'll learn how to avoid those errors or to spot valuations that might be biased or rigged. The participants should be able to use the knowledge obtained in order to review valuations of other analysts also. And we'll try and give you some tips on how to avoid errors in the performance of the valuation engagement. Note, it's my normal practice to provide as much material as I can for the attendees. As a result, I might not cover every slide included in the presentation. The slides I do not cover raise questions. Please feel free to send me an email and I'll answer your question for you at a later point in time. Now we're going to have a couple of poll questions as we go through here, and so I'm going to throw this back to Elise for the poll questions, and this is in order to qualify for the CPE that you will get by attending this presentation today.
The poll question is open now, and I'll leave it open for about 30 seconds. All right, I'm going to go ahead and close the poll. And Jim, back to you.
Okay, thank you. And I'll be interested to see the response on there, although I can probably guess what the answer is going to be in most cases. So how do we find these errors? To find the best way to find the errors or the riggings or whatever it is you're looking for is to look to the process. So the process of actually completing the valuation and reporting on the valuation. In most cases, the report should give you a good map in order to start your review. In some cases, it will not. For example, in the case of the BV standards from the AICPA, which I was part of the writing task force on that, there are cases where and there are litigation cases where there's an exception to the reporting. So in those cases, you might actually have to review, if you're reviewing somebody else's report, their actual work paper file, which must document the process. So I think most of us know that there are three approaches to valuing a business: the asset approach, the market approach, and the income approach. So let's start in reviewing our errors with the asset approach. The primary method under the asset approach is the net asset method. Now, it's a very difficult method to apply, and some of the problems that you have is a failure to identify all of the assets, tangible and intangibles. And that's one of the problems with the net asset method, is you've got to value the intangible assets as well as the tangible assets. So there may be a situation, there often is a situation in the asset method that some of the assets that you have valued are presented at the incorrect standard of value. So in looking at both real estate and machinery and equipment type valuations, you can have, as you can see on the slide, up to 6 different types of standards of value that the appraiser who may be helping you and assisting you to determine the value of the assets may be using. And any one of those might or might not be appropriate for the purpose of your valuation. For example, if you're doing a dairy, not a dairy, a milk processing plant, which I had to do in one valuation engagement, the milk processing plant, you walk in the door, you find very quickly that all of the machinery and equipment is a continuous process, and most of the stuff is actually fixed and in some cases even built into the walls of the milk processing plant. So obviously it's going to be very difficult to remove that stuff, and if you do remove it, you basically have scrap value is all that you have for the equipment and the machinery that's in one of these milk processing plants. So as a result, if you're looking at the fair market value on a going concern basis of a milk processing plant, your assets that are built in are going to be much different value than if you're looking at a scrap value or trying to move it. You can't really move a milk processing plant very easily and be able to recoup the value of the equipment. So that's just one example. Using incorrect methods then in valuing specific intangible assets is another situation where you could find that you can easily make an error. Again, you have to identify all those assets to begin with, but you also need to make certain that you're using the right method of valuing. So you may, for example, apply a royalty method when you should be applying an income approach method, something similar to that. And determining the value of goodwill is extremely difficult in the net asset method. So if you believe in using your net asset method that there is goodwill in the business, you may have to give a second thought to using that approach, the net asset approach. The excess earnings method is also considered part of the asset approach. And the excess earnings determines, as most of you know, and by the way, I'm not going through the basic methods under these approaches because I'm making the assumption here that the attendees have a baseline knowledge that allows them to understand the methodology. So in the excess earnings method, you would be using, first you would determine the earnings that are available in order to value the company, and then you would determine the returns on the tangible assets. And once you determine the returns on the tangible assets, you subtract that return from the overall income, and what you have left are the excess earnings that apply to intangible assets. So some of the problems with that methodology is it's very difficult in determining the value of the tangible assets, as we've already discussed previously, and there's a difficulty in determining the return. So you've got a double-edged sword there. Determining an appropriate return on intangible assets is even more difficult because, remember, intangible assets relate to the excess earnings. So you would expect that those earnings would have a return higher than the tangible assets, and indeed they do, but how to determine those can lead to errors in your valuation. Failure to deduct interest-bearing debt in determining excess earnings method, equity value can often be an issue. So if you're doing that excess earnings, again, in order to get to the equity value, you have to take out the value of the interest-bearing debt. Notice it's the value of that debt, and not just necessarily what the dollar amount of that debt is. Failure to conduct a sanity check is also a problem because the overall capitalization rate should be in line with the overall capitalization rate that you might have used in determining the value on an income approach. Let's move on to the market approach. The meat of this, I want to get into the income approach, so I'm just going to go quickly through this. Under the guideline public company method, you may find yourself using too few guideline company methods or using too many. And the biggest problem is selecting the right size and industry and making sure that the companies you do select are comparable to your subject company. So failure to adjust and normalize financial statements of the guideline companies that you selected is also a problem. You got to make sure, for example, there are no non-recurring earnings in there, no one-time adjustments to earnings, and you also need to make sure to look at the stock, the number of shares of stock outstanding, because the price per share could change based on some of those issues. So those are some of the things that you need to look at. Also, selecting incorrect multiples, failure to exclude non-operating asset income and expenses. And that's a big one because in your, not only do you have to do that for your company, but you need to make sure that the guideline companies don't have anything to adjust on also. But this mainly relates to your company, is that you need to take the income and expenses related to non-operating assets out of your base in determining your value. And then related to that is you need to make sure that you add back or deduct non-operating assets and liabilities. Using the merger and acquisition method and the market approach or the transaction method, whatever you want to name it, there's a big problem if you start mixing databases. The databases are unique, and so if you're going to use multiple databases, you have to make certain, first of all, that you do not add the elements of a transaction in one database in with the elements of the transactions in another database. And if you do, you're going to get a really bad answer right out of the box. But even if you're using multiple bases, you need to understand the intricacies of each of those databases, and sometimes it's not good to even choose a certain database at all, depending on the subject company that you're valuing. Rules of thumb method. Rule of thumb is technically not a valuation method. Some people use it. Most people use it as a sanity check. Now, the business valuation standards for the AICPA, the SSVS or the S100, as it's now named, they will allow the consideration of the rules of thumb, and they don't say outright that you can't use it, but you should try and corroborate that answer with one of the other methods, because if it's too far out of line, then you're going to have to give some good reason why you're going to support it. Now, there are some industries like auto dealers where there may be a particular rule of thumb in determining the blue sky in an auto dealership, for example, that might make this an allowable situation. However, it is likely an error when used in many businesses, but again, can be used as a sanity check. And throw it back to Elise now. We've got another poll question here.
That poll question is now live, and I'll leave this open for 30 or 45 seconds so everybody has a chance to answer.